Hi there, I'm Lindsay Biscaya. Welcome to Market Call. Greg Newman is on the show today. He's Senior Wealth Advisor and Portfolio Manager at Newman Group, ScotiaMcLeod, and we'll be taking your questions on North American Equities. Here's how you can call us. You can reach us toll-free, 1-855-326-6266, or you can send us an email, marketcall@bnnbloomberg.ca. And you join us in studio once again. It's good to have you in.
Great to be here. Thank you very much.
What an interesting year it's been so far for the markets in particular, don't you think?
It really has been. It's been more of a story of equal weight. It's been more of a story of TNX. Of course, you've had the metals that had a stunning January and then had this incredible fall, and now they're trying to base. And you got the S&P that's testing its 50-day moving average right now, and the Nasdaq that's testing its 50-day. So lots of themes, lots of things going on.
It seems as though there's a little more optimism. I've been noticing that even just in the last week. It seems as though people are feeling a little more optimistic, maybe yourself included. Correct me if I'm wrong, because you're saying markets are priced for good outcomes as long as there's some cooperation from a couple of different factors.
Well, I think that you've seen a few reasonable things in the last week or so. You've seen inflation coming down relatively in check. You've seen the employment numbers in the U.S. that have been pretty good. Everybody, all eyes are on earnings season. Everybody was expecting earnings to be up 11% for the quarter. They're actually up 15%, which is really, really great. And what drives markets? It's earnings and interest rates. And both of these things are cooperating fairly well. Tariffs seem to be, passing through for the most part, not causing big inflation. The concern was, and the concern remains, the new Fed chair. Is he going to try to lower, is he a hawk? Is he going to try to lower rates? So there's uncertainty there. And of course, you've got this real theme about software and it bleeding out. But you got to remember, the software stocks are now trading at around 20 times PE, which is a normal level. And they were just so inflated at the start of the year. So this sort of behavior would be expected in an unfolding bull market.
And I think that's something we're going to have to keep watching for, right? Is AI and the disruptions it might cause, what industries down the road or throughout this year?
Well, this is the question. And, you've really had this dispersion in the Mag 7 and the winners and the losers. And, lately Google's been winning. And are they overspending? And, the market seems to be thinking that there's, very few winners, at least in tech land. And the truth is, these are the smartest companies in the world. And they're not spending $180 billion for nothing. I mean, they see the return there. And the valuations of most of these companies are very reasonable. I mean, if you're talking about a Google, for example, maybe around 21 times at around an 18% growth rate. Microsoft, the same. So they've all come into very reasonable territory. There will be a time when this is not the trade anymore. I promise. But for now, I think it really remains a really good investment to buy on the dips.
Okay, we'll be talking about that a little bit more in the show, but we're going to take a quick break right now. We'll be back with Greg Newman of Newman Group and ScotiaMcLeod taking your questions on North American Equities right after this. Stay with us. Welcome back to Market Call. We're going to go straight to the inboxing and pick up a viewer email question from Pete. And this email reads, short and sweet, thoughts on Broadcom. What do you think about Broadcom right now?
Okay, well, listen, I'm going to break it down. There's two types of fears going on. There's macro fears. Everybody knows AI overspending. Are we in diminishing returns? Circular financing. Are we in a bubble? And then, of course, there's stock-specific fears, which is it's a highly competitive market. Top 5 customers account for 40% of revenues. They have high debt levels from their past acquisitions. This could affect future acquisitions. But really, if you step back, I mean, the name has had a stunning run since 2022. The thirst for the products are unprecedented. Acquisitions continue to be a growth driver, big cash flow, very sustainable dividend. Analysts like it. Over the last 30 days, 7 have upgraded. And when you shake it all out, 23 times earnings, 2027 growing at 34%. So I'm a buyer of Broadcom right now at these levels.
Okay, we'll leave it there. We're going to go to the phones now because we've got a caller. Andre is calling in from Chilliwack, BC, with a question. Hi there. What's your question?
Good morning, Lindsay. Can you hear me?
I can hear you.
Okay, great. Thanks, Greg Newman. It's a buy on Broadcom. I own some. Could I get your thoughts? Could I get your thoughts, please, on a small little turnaround story on Algonquin Power? It's been upgraded to outperform by National Bank on January. Could I get your thoughts? And quickly, could I ask another question? Is how much influence does the analyst community have on you when you decide to pull the trigger and buy a stock? I'd like to hear that. I don't think anybody's ever asked you that. Thanks, and have a great day to both of you.
It is a good question. Thanks, Andre.
Gosh, that's a very flattering question. My goodness. No, look, we'll take Algonquin.
Yeah.
Last quarter, a nice beat. Core utilities are very strong. They're making progress on rate filings. You look back, energy infrastructure is a good theme to be for many different reasons. These guys have righted their ship, and I think the upgrade that they just got is very justified. We like it. I've been buying it since the 6s and the 7s. All in, 13 times 2027, much cheaper than the peers, and modeling about 14% earnings per share growth. So combine that with a nice dividend and 6 analyst upgrades over the last 30 days, we like it.
You like it. Okay. Chris now calling in from Delta, BC with a question. Hi, Chris. What's your question?
Oh, good morning, Lindsay and Greg. Greg, great to see you back on the show. I'd like to ask you about Brookfield Asset Management. It's been quite volatile, especially not just today, but over the last few months, and I've sort of been picking away at the dips, good dividend payer. I think most guests conclude that for a long-term investor such as myself, 10-plus year time horizon, that Brookfield Corp is the superior pick, but I've kind of opted to have a bit of both, and I'd be interested to hear your thoughts. I'll hang up and listen. Thank you both.
Okay, thank you.
You know what? I think that's great. I mean, it's they're both really good choices between the two. I think the parent, Brookfield Corp, is the better way to go. But as of last quarter, we haven't been reported yet, but their Q3 was they did. Their Q3 was intact. Very big in fundraising infrastructure year in 2026. So we're looking forward to that. Basically steady as she goes at 24 times price to distributable earnings, 16% growth rate. Not bad. I think the asset managers, have had a little bit of a hard time on concerns and fundraising, and there's some credit issues out there, looking at maybe on the loans to software stocks and that sort of thing, and maybe there's been some gyrations for that. All in, a reasonable story. If from a risk reward, don't know, it's the first place that I put new money, but it's a very reasonable hold.
There was also a mention from Chris about the dividend yield for Brookfield Asset Management. It's right now just over 4%. Is that something that's important to you? If you're
of course. I mean, when you look at the Brookfield universe and you look at the stubs and that sort of thing, there's always, you look at the renewable and you can get like about a 5% dividend there. And if you look at the infrastructure plus that. And so, yes, it's part of the total return, and there's various times where you want to own the satellites and the stubs.
Okay. Okay, Daniel in Markham, Ontario is calling in now with a question. Hi there. What's your question?
Hi, Lindsay. Hi, Greg. Great host and great guest. My question is on Tourmaline Oil and Canadian natural gas. Out of Tourmaline, Arc Resources, Peyto, or Birchcliff, what's your top-ranked Canadian natural gas company you would buy today? Thanks for taking my call.
Okay, that's a really, really good question. Okay, for upside torque, I'd probably go Advantage. I think Arc is a little bit in the penalty box because they're having some proving out of developing some of their resources. Tourmaline, they've got, a lot coming on in the pipeline and a lot of spending for 2027. So the market's a little bit shy of that. But I like it. I mean, I think post that, I think this is the sleeper. And if I were going to be putting new money in, combined with the dividend that's relatively safe, 6.5 times EV to discounted adjusted cash flow, 6% production growth, 8% cash flow per share growth, reasonable balance sheet at 0.6 times debt to cash flow. I think these guys are a key beneficiary of AECO increasing and getting resource out of Canada. So I like it, and I think it sets up really well down here.
So you like Tourmaline, but did you say you liked Advantage better?
If you believe that natural gas prices are off to the races and are going to, go straight up from here, Advantage is the better bet, but it doesn't pay a dividend. This is a dividend. This is a little bit safer. If you're looking about registered assets, I would go Tourmaline.
Okay, I think we have time for one last question. We've got an email question from Carter. It reads, what does Greg think of MDA Space? Company we talk about a lot here. Do you have any thoughts on MDA Space?
Well, they just really had this nice run over the last couple of days on these defense announcements, that really has benefited the whole defense complex. Pure play on growing space, strong backlog with governments. I think the issue here was there was an EchoStar contract in September that got put on and then pulled, and there's some question marks surrounding, what does their existing backlog look like? They're also 31% U.S. So what happens if the USMCA agreement doesn't go through well? I think investors are nervous about that. But we're modeling about 14% earnings per share growth. Trades are around 21 times. Price to growth, given the defense spending that's happening right now, not a bad buy here.
Yeah, okay. We're going to be right back in just a moment with Greg Newman of Newman Group, ScotiaMcLeod, taking your questions on North American Equities. Stay with us. Welcome back to Market Call. Greg Newman here taking your questions, and we're going to go to the phone lines. Elliot is calling in from Hamilton with a question. Hi, Elliot. What's your question?
Good afternoon. Premium Brands, the corporation, has been making significant progress. Share price has drifted from the 80s to 105. Are we now on the cusp of significant share price appreciation, or is all the goodness baked in? Thank you.
Okay, thank you.
That's a great question. Listen, I think one of the reasons why this stock has reacted is, I call it the everything else trade. Since software has been bleeding out, since the Mag 7 has been getting threatened, everything else, and particularly the small caps, have really had a big rally here. So people are taking a look at this name, which has good value. Is it time to buy here? It depends on beef costs. Depends on, have beef costs peak? I think, and are we going to see margin stabilization? That's the question here. I think this is a good stock in that it is not an if, but a when. I think you're at reasonable levels here. 12 times 2027 with a 29% growth rate if things work out well. So you want to be more of a buyer. I mean, I don't know that I'd buy it at 105. I think that what you're going to see is a catch-up trade now for the Mag 7, and then it's going to cause the appetite for these other stocks to kind of drop. But if you can get this around $100, I think this is a good stock to own.
Okay, so wait and see if it drops just a little bit.
Yeah.
All right. Anita is calling in now from Markham, Ontario with a question. Hi, Anita. What's your question?
Hi, good afternoon, Lindsay, and good afternoon, Greg. Thank you for taking my call. My question, Greg, is on Caterpillar. Is this a good entry price? And do you think it's a good idea to get into such capital-intensive stock at this time? I need your advice on this. And Lindsay, do you think I could get a street consensus on this, please? I was debating between Caterpillar and Deere and Company, but whichever is fine. Thank you so much. I'll hang up and listen to you.
Thank you.
Anita, how many times have we chatted on this show? Quite a bit. And I hope I haven't led you astray too much. But I don't know that I'd be. First of all, the equipment dealers are a great place to be right now. They pass through inflation very well. They're a good play on mining. They're a play on global growth. You could see Finning how. It's the same chart that we have in Canada with Toromont, with Finning, not so much with Wajax. Do you want to buy them when they've had that kind of run here? I would say that technically it's over its skis and you don't want to be buying it here. But is there legs for the next 3 to 5 years for this theme? There is. So you can buy CAT, but I would say you want to buy it at a lower level. And I think you could get a better deal in a Finning, but same thing, buy Finning at a lower level.
Okay, Caterpillar also consensus rating 15 buys, 11 holds, and 2 sells for that company. We're going to go back to the phone lines. Alan is calling in from Victoria, BC with a question. Hi there, what's your question?
Oh, hi. Thanks, guys. Hi, Greg. My question is Exchange Income Corporation, another stock that's been on a heck of a run. What do you think?
Thank you.
I like it. I like it a lot. You know, they have real good pricing power in the Arctic, and their industrial portfolio seems to keep powering on, and they are their growth by acquisition story, M&A, some organic growth. You combine it all in, and 15.5 times 2027, growing at 19%. Benefiting also from this everything else catch-up trade because everybody's paying a lot of attention. It is small cap. It is kind of whippy. But last quarter, we're going to find out about the new quarter, but everything's been going pretty well. I've owned this name for many, many years, and it's a good, steady performer. I wouldn't buy it right here for the same reasons I just explained about CAT, but it is a good long-term hold.
And small caps might be having a bit more of a year this year. That might be another conversation for another time. But
it's a big theme, and I'm totally behind it. And it is interest rate dependent. But so far, if you look at what's worked in the S&P 500 and the TSX, it's been the small caps, and that's going to continue as long as interest rates go in the right direction and exchange income. But we'll be part of that. But you're sitting right here on top of a parabolic move, and I don't think you buy right there.
Okay. Next caller, Gulam calling in, in Toronto, Ontario, obviously, with a question. Hi there, what's your question?
Hi, good afternoon. My question is on Propel Holdings. I bought that when the stock took a real drop in September, so I'm just about breaking even right now. Is it a time to add to my position, or where do you see the stock going in another few, in a year, let's say in a year? Thank you.
Okay.
You ask a really good question. The market is really focusing on portfolio loan quality. Last quarter, earnings per share momentum was slowing. Loan balances did, however, hit new highs, which is good, but the company did reduce their full year guidance, which is never good. Technically, it's done a double top, and it's at a level now that I think you can buy. But I mean, Trump is threatening to reduce credit cards and the amount of interest that they charge, and that fears everybody. There's a lot of fear out there. Mm-hmm. You want to buy the fear, generally speaking. And is it at a level now trading at around 7 times with about a 29% growth rate? I think so. I think that you want to buy this, but it is a small cap. It is whippy. It is a new company. Don't buy this in a registered account or a TFSA unless you've got a different mindset about the TFSA. But for me, I want to hit singles and doubles in those accounts. And this is more of a very high torque stock. When this stock works, it's going to go up a lot. But own it in your non-registered account.
Okay, good to know. We're going to take another quick break right now. When we return, though, we'll take a look at Greg's past picks. That's coming up right after this. Welcome back. Time now for Greg Newman's past picks. These are from January 23rd of 2025, so just over a year ago. We'll start with your first one. That is Citigroup, so recommended at $81.98, now at $114 or over that, total return of 43%. This one did pretty well.
Yeah, listen, does it have more to go? It does. Q4, they beat on NIMs, lower PCLs. They're committed to reach their ROE target. This isn't your most impressive bank. This isn't your JP Morgan, but this is a healing story and a transformation story. They had record revenues last quarter. Operating leverage looked good. Company says they're entering 2026 with momentum. And we bought it because it was cheap last year at around 8 or 9 times. It's still 9 times earnings, even though it's had that growth because the earnings have come up. And we're modeling 16.4% growth. So there's still more to go in the Citigroup trade.
Newly appointed CFO, I see as well. So a lot to look forward to for this company.
I think so, yeah.
Yeah. Okay. Your next past pick was Power Corporation. So recommended at $42.89. Now it's $65.47. A return of 53%. Total return of 58%.
Yeah. And, they've sold off recently. I think really on the everything else trade, this has had a big move. I think it participated a little bit in sympathy or in it's kind of moved with Robinhood in the States, and crypto has sold off. So Robinhood's moved up, and that's because they own that through their Wealthsimple. But we think that can actually give them another 30% of upside over the next 5 years if Robinhood really works. And of course, so what I'm talking about is Wealthsimple here. But, so you get that upside of those stubs, but you get also this real nice dividend, solid EPS growth, good organic growth, all systems go, dividends, buybacks, 12% growth rate, trading at 10%. Still want to own this name.
Okay. Lastly, Intact Financial. So recommended at $259.84, now at $264.24, total return of 4%. So you still holding this one?
Yes and no. We really did sell this, at over 300 as the Trump tariffs were coming down in March and April. And we felt the stock didn't owe us anything. And the growth rate started to change. It's getting pinched a little bit in commercial pricing. And it still has a decent valuation. It's trading below about 2.4 price to book versus about 2.75. It's 3-year average, reasonable at 14 times 2027. But we do see flattish EPS growth from here. So if I were going to buy a P&C, property and casualty, it would be Definity that I'd be buying. But I think it's too early for both of them, with commercial being in question right now.
It still did well for you, though. It's a little bit of a pricier stock. Is that, correct me if I'm wrong, it seems as though that's not usually something you go for? Or
yeah, Intact? That's a great question. Thank you very much. Certainly the first two were very cheap. This one was more of a price to growth. Right. And it worked on a price to growth, but the growth hasn't been as good, over the last 12 months.
Okay. All right. We're going to take another quick break right now. We will be back with Greg Newman of Newman Group, ScotiaMcLeod, taking your questions on North American Equities. That's right after the break. Welcome back. Greg Newman is here taking your calls today, and we're going to go straight to the phone lines. We've got Frank calling in from Huntsville, Ontario, with a question. Hi, Frank.
Oh, hi. Thank you for taking my question. I'm interested in buying TD Bank, but I have two considerations. One, it's had a run-up for the last few months, and I don't know if it's too high or this is the right time to buy. And secondly, should I wait? I believe the earnings are coming out next week. Should I wait for the earnings to come out before buying? I'll hang up and listen to your answer. Thank you.
Thank you very much.
What a great question. We do think next quarter should be and it's coming up in the next week or so, should be very constructive for the banks. You got really good market-sensitive fees. You got upside to margins with growing NIMs, and even with less loans and less loan volumes, credit losses remain pretty manageable, and we see upside surprises. So that's the story of the banks. In terms of TD, look, one of the things that the market was really concerned about was asset caps here in the U.S. And last quarter, they were under that 10% asset cap by quite a bit. So leaving some really good room for growth in the U.S., which clears up some of the problems. They're cleaner credit than many of its peers. And all in, we're modeling 10% for this name. And it's trading a little bit pricier than some of the other banks, but it's reasonable here. Would I buy right now before these earnings? You know what? I could be wrong, but no. I'd let them breathe a little bit. I think that you've had a very, very, very big run here. I think investors are getting comfortable, or used to being comfortable, with a new valuation range for banks, which hasn't worked since the global financial crisis. I mean, typically they were 11 to 12. Now they're like 13 or 14. They're probably going to be in this new range, but I think there could be some fickleness there. So all in, my call would be wait.
Okay, and earnings for TD February 26th, so that's a week today that we'll get those coming out. Back to the phone lines now. Robert in Burlington, Ontario is calling in with a question. Hi there.
Good afternoon. Greg, I love it when you're on. You're a straight shooter, even whether you disagree with me or agree with me. I've asked you about Well Health before on a financial level, but I'd like to ask it a different way. Well Health is an up and growing company. They're firing on all cylinders. They got all the latest technology. We need it so badly in our healthcare systems, to the point where pretty soon every Canadian will have a family doctor, and especially be able to push a button and tap into the top specialists across the country. But everybody seems to be picking on this company and bashing it. Investors don't want to deal with it. Even the Canadian government's after it. And instead of trading between $3 and $4, it should be trading at $5 and $6. So Canada tends to drown the baby and keep the bathwater. What's wrong with us? Can you try to explain it? Thank you.
Well, I think it. There's some concern from the Competition Bureau about some of their acquisitions. So I think that's one of the concerns. The story has been really good. I mean, the revenue growth last quarter was up 56%. Mm-hmm. The organic growth was up 19%. But we do see maybe a little bit of weakness in that growth story over the next 12 months. But the name is really cheap at 9 times for an exciting growth play. I agree with you. I agree that I think that this is something that you want to own in the non-registered account and try to not avoid the noise, because I think it's not an if, but a when story. And I think your patience will be rewarded.
Own and hold on to it for now.
Yeah.
Okay.
Yeah.
Robert's calling in from Etobicoke now with a question. Hi there. What's your question?
Oh, hi. Thanks for taking my call. First-time caller. Greg, I'd like to ask you, I am considerably overweight in a number of Canadian oil companies, and recently they've all ripped up very, very nicely.
Yep.
So do you think this is being driven by geopolitical concerns, or is there something else going on in the oil patch? And then specifically, CNQ, which has had a terrific move up, do you think that it's already priced in for a big beat when they report next week, or might there be more to go? Thank you very much. I'll hang up and listen to your answer.
First of all, you got to draw a distinction between Canadian oil stocks and the rest of the world. Canadian oil stocks should outperform because it's been years of underdevelopment, and we're getting resource offshore, and our differentials are going to be closing, which is great. CNQ, next question, is profitable down to below $50 WTI. It's a great story, decades of inventory. I like it. Very, good balance sheet, 7% shareholder returns, nothing not to like. In terms of whether I'd be buying oil right now, I think that energy's really benefited from this everything else trade. When money's gone out of the Meg 7, it's gone somewhere. It's gone a lot of it into energy. And I think that there's also this pop from maybe a possible conflict with Iran. So those two things have caused the area to swell. I personally think that oil prices longer term are going to have a bit of a hard time for 27 and 28. And I would be fading this rally. So I would be buying the natural gas stocks. I would be buying Tourmaline, which haven't really reacted. And I would be shy of CNQ, of adding to CNQ. I own it. I love it. It's a great name, but I wouldn't be adding more to it right now.
Okay. Now, George calling in from Toronto with a question. Hi, George. What's your question?
Yes, good afternoon. Thank you for taking my call. I have a modest position in GoEasy. I'm curious whether your guest can comment on, first of all, when is the earnings report coming up, because I can't seem to find that, and just basically an insight into GoEasy going forward. Thank you very much for taking my call.
Thank you.
They've struggled. They've struggled with the fear that there could be increased delinquencies, credit losses, same as Propel. Their earnings last quarter missed by 11%, which nobody likes. New CEO was announced. There's some internal things going on that maybe cause some confusion and anxiety. All in, I think this name is cheap, like Propel, trading around 5.3 times with still a decent growth rate. Whippy stock, small cap. Guys, don't own this in a registered account, but yes, own this, and you can buy it in a non-registered account.
Okay, we're going to take a quick break right now. We'll be back with Greg Newman of Newman Group, ScotiaMcLeod, taking your questions on North American Equities right after this. Stay with us. Welcome back to Market Call. We've got Greg Newman here answering your questions today, and we're going to go straight to the phone lines. Jacob in Toronto is calling in with a question. Hi, Jacob. What's your question?
Yes, good afternoon to both of you. And I'd like to ask about the Shopify. Is it? I have some of it. I'd like to know, of course, a specialist, whether to keep it or sell it. Thank you very much, and have a nice weekend.
Thank you for that question. What
Look,
do you think?
the trouble with this name, this was a topic of mine in the very beginning, in the $30 before it split a few times, 10 for 1. Look, the trouble with this name, it's always very expensive. It really, really is. But it's finally come down to a level that it is not so expensive. Modeling 46% earnings per share growth and trading at around 46 times 2028. I'm stretching it by not doing a 27. But they beat last week and their outlook, they raised the bar, but there's so many AI fears right now. We think they have a wonderful solution with agentic AI and commerce tailwinds, but the market is treating it like all these businesses are going to go away, or that the lifeline of the assumed enterprise of the business is going to be shorter than it otherwise would because of new AI. We think AI helps to enable their business, helps to grow. Everything that we've seen, their merchant solutions were up, the GMVs were up. They're buying back $2 billion of their own shares. I always say when smart guys are buying back their own stock, it's a good sign. Yeah, I think you want to own more Shopify.
It just seems like there's a lot of fear right now from investors, right, around AI and what it could do to these companies, and Shopify is just getting caught up in that.
Well, for good reason. I mean, we are living in a world where there's so much fear, right? Yeah. Like there's so much change, profound change that's happening. And AI, I'm not going to, diminish it. I mean, it's going to change the way we live. It's going to change a lot. There's going to be a lot of companies that really benefit from it, and there's going to be those that are hurt by it. So I think investors are asking the right questions.
Okay, now back to the phone lines. Bruce in Simcoe, Ontario is calling in with a question. Hi, Bruce. What's your question?
My question is on Merck, and I understand a week or so ago some insiders were selling, but it seems like it's recovered from the little dip. What would you recommend? Buy, sell, or hold? Okay.
Thanks for your question.
This is an erratic and bumpy name. It was very ignored by the market for a long time. It's been, people are really concerned about their Keytruda falling off and what's going to replace that. So it's a pipeline story, it's an execution story, but it's also, a valuation story. And it's at a level that it's 12 times. They just beat their Q4 and their revenue beat as well. I think the key continues to be their visibility on post-Keytruda, which is looking pretty good. So all in, I think that you can own this name.
Okay, Kurt now calling in from Calgary with a question. Hi, Kurt.
Good morning. Thanks for taking my call. My question is on Telus this morning with the new CEO. I was wondering whether you think the dividend is safe. Thank you.
Thanks for that.
I think that's a great question. Look, Darren out, Victor in. Victor did a great job with CIBC. Dividend was sacred under Darren. And, last quarter was in line. Like the telecoms, we're not looking for a lot of growth here. Part of my thesis in December for these to work was pricing discipline, and you haven't seen that. You've seen, a lot of $25 packages, $35 packages, which is really delaying the recovery in these names. Name is cheap, and with an okay growth rate, price to growth works with a nice dividend. However, will the dividend get cut? You ask a great question. I think it probably will.
It's at 9% right now.
Yeah, I think it's probably going to get cut 30 to 40% is what I would bet. And I actually think the stock will rally. If that were to
It will
happen.
rally. Okay, so you're saying it's
I think it's part of the solution. I think the payout ratio is too high. I think the telecom situation in Canada is not a lot of growth, not a lot of population growth, lots of regulation. Companies are scrambling. They're having to do something. You know, BCE's been doing things. I mean, they got their answers longer term. Rogers has its MLSE spin out. I see probably, I believe, more than 50-50 chance they're probably going to cut.
Okay. Next up, we're going to go to the inbox. We've got an email coming in from Cy, and it reads, I want Greg's opinion on Constellation Software. I bought it at $4,500, and it has had a 50% haircut. Should I hold on to it? Thanks.
Well, that's such a great question. I mean, this has been one of the best stocks to own for TSX holders for years and years and years. And like all stocks, you know, I don't care whether it's BCE, I don't care whether it's the banks, General Electric, all blue chip stocks really have their gut check at some point. This name has gotten very cheap, and it really depends on, you know, can their roll-up strategy of buying and integrating continue in the AI world that we have. They've had some CEO shuffles as well, which has caused panic. I mean, where do you buy the software stocks? Where do you buy ServiceNow? Where do you buy this one? Given the metrics that we've been looking at, we think that probably 90% of the software carnage is done. So you're at levels now where, at least for a trade, I think you're looking at a good buy here.
All right, we're going to take a quick break right now. When we return, though, we will take a look at some of Greg's top picks. So that's next. Stay with us. Join us tomorrow on Market Call. Brianne Gardner will be on the show. She's Senior Wealth Manager at Velocity Investment Partners of Raymond James, and we'll be taking your questions on Canadian and U.S. large caps. And if you miss Market Call, you can always check out our daily podcast. You can find it on iHeartRadio and other platforms, and you can also watch full episodes on our YouTube channel. And time now for top picks with Greg Newman. So we've got a couple here. The first one, Nvidia, still going strong, you think?
Right. Well, so, you know, what's the criticism? What's the knock? I mean, first of all, the stock hasn't made anybody any money since the summer. Concern is circular buying, same capital, chasing, same names, AI bubble. You know, increasing competition out of the likes of Google and Amazon. I think investors have rightfully very painful memories of JDS Uniphase. That's 25 years ago. You know, and the other side of the mountain, and what's going to happen when we get on the other side of this cyclicality. You got legendary investors like, you know, Burry that are betting against it with put options. But I think that the doubters are way too early. You know, they just expanded a deal, I think last night or the night before, with Meta for millions more chips. The CEO, I think he's calling it best he can, and he says he sees no AI bubble. Q3 they beat. Blackwell sales are off the charts. Earnings are up. We're up last quarter 65%. We're going to get their earnings next week, next Wednesday. I think that's going to be a very big moment for the market. And I think Google, Amazon, and Microsoft are all duking it out. And I don't think they want to buy chips from each other. They want to buy it from a third party, which favors Nvidia. So, you know, meanwhile, the buyback continues. Excellent risk reward, in my opinion. Where else are you going to find a company that's growing at 39%, owned this widely, trading at 24 times? So it's crowded, I admit it, but I think that there's more to go, and I think investors that don't own it are making a mistake.
And as you say, people are worried about what happens when we get to the other side of the mountain, but doubters are a little too early. Like, how long will that take?
You know, that's a great question.
It seems like it could be a while. Maybe not.
No, listen. I mean, that's what analysts are always trying to ascertain. Like, what is and right now, you know, the growth rate seems to start to slow, according to the 50 analysts in 2029. That's their best guess right now. I mean, and it slows to what? To 12%, which is still not bad. But, you know, they keep pushing that out the longer we see what's before us. So, I wouldn't be surprised to see it go on longer than that.
Okay.
But the problem with markets and the inflection is you have to see it before, because by the time it becomes obvious, stock's already fallen in half and it's not going back to where the tops.
Tough to do to see it before it's too obvious. Okay, next up is Colliers. What do you like about this stock?
So this stock got really pummeled on fears of AI disruption. I think that maybe interest rates not coming down as fast as what people thought maybe hurt it a little bit. They did a recent acquisition, which increases their leverage. And I think the market's maybe fearing they're going to do a debt issuance or an issuance. But the recent acquisition looks accretive to us, 3%. We heard from the company about being outsourced by AI, and they said it's ridiculous. They said complex broker services like we do, AI is not even close to doing anything like that. Meanwhile, I think the market is ignoring 5 to 6% organic growth plus 10% from acquisitions. They got a tight ownership of about 30% internal. Rate cuts should come in, which is the cyclical part of the play. Then you got the secular tailwinds, which is growing in urbanization, growing in infrastructure, energy transition, and globalization. These guys are there for all that. The knock is that the balance sheet is a little bit in debt, but we see 2 times leverage by 2027. And 14% growth, 15% growth, pardon me, at a 14 times valuation. I like it. I think you buy it right here.
Okay. Last up is Microsoft.
So, what's the concern? Every time you get Microsoft trading at around 21 times, growing at around 19%, please buy it. Please buy it. Obviously fears here of overspending. Will they get a proper return? This most recent quarter, they're fearing Azure growth, growing now only at 39%, which is what the market thought, but it missed the whisper, I guess, of 40%. There is a concentration risk that I think investors are worried about. 45% of their commercial backlog is tied to OpenAI. And, there's concerns that Gemini and Anthropic are cutting into ChatGPT, and Google's the hot one now. But wouldn't be surprised to see them go back and forth. And I think this one will be the hot one again, OpenAI. Stunning quarter, EPS beat, revenue up 17%, earnings per share up 28%. Commercial bookings were up 230%. To me, people are concerned about the business. It seems to be only accelerating. So I think it's a bit of a no-brainer to be buying it right here.
And you mentioned this off the top, and we talked about this at the beginning of the show too, right? Like a lot of investors worried about these big companies, including Microsoft, with that aggressive AI spending. But as you said off the top, they probably wouldn't be doing it if they didn't think they were going to get return on that.
Well, you know what? It's for investors to judge the intelligence of these decisions. And at some point, it'll probably be too much, and there will be the other side of the mountain. And it's a very healthy market and gut check to be questioning these things.
There's also a time limit, too, about how long investors, will their patience wear thin before seeing results from this spending, do you think?
Yeah. I mean, that's part of this. I mean, these were enormous free cash flow monsters, these companies. And they're not so much anymore because they're doing all this spending. But I think it's really going to pay off.
Okay. All right. That's all the time we have, Greg Newman. Appreciate you coming in. Great to have you.
Great to be here.
And thanks for watching Market Call. We will see you next time.